Ever feel like you're just swimming in financial news? So many reports, so many numbers, but do you really get what's happening behind the scenes?
It's a lot, definitely. Information overload is real.
Exactly. So today, we're offering a bit of a shortcut. We're doing a proper deep dive into something pretty crucial, but often, let's be honest, a bit confusing. Company acquisitions.
That's right. Our mission, if you like, is to really unpack fair value when one company buys another, especially how it feeds into calculating goodwill.
Goodwill, okay.
Yeah, and this isn't just, number crunching for accountants. It's about getting a true picture, an accurate economic view of what happens when businesses combine.
And why should you, listening right now, care about this? Well, understanding how these huge deals are actually put together on paper, how they're accounted for, can totally shift how you read financial statements. It often reveals things that are, frankly, quite counterintuitive. We'll show you how this idea, fair value, touches pretty much every part of these calculations, sometimes in ways you really wouldn't expect. Okay, so let's unpack this then. Goodwill in an acquisition. What is it? Exactly. And why is fair value like the absolute bedrock for calculating it?
Okay, so goodwill at its simplest is what's left over. It's the difference between what the parent company pays for the subsidiary.
The purchase price.
Right, the consideration. The difference between that and the fair value of the subsidiary's identifiable net assets. So the stuff you can actually point to and value: buildings, inventory, patents, minus liabilities.
Okay.
But here's the key thing. For the consolidated financial statements, the big picture, combining both companies' the rule book, specifically IFRS 3 business combinations, is very clear.
IFRS 3, right.
Yes. It demands that both the payment made and the acquired company's assets and liabilities are measured at their fair value on the day of acquisition.
And that's a big deal because?
Because it's a foundational principle. It often overrides the specific accounting rules that might apply to those items in the subsidiary's own standalone accounts. Consolidation rules can trump individual rules.
Okay, that's the aha moment, isn't it? The idea that the rulebook changes when you combine companies. The consolidated view follows different, sometimes stricter valuation rules than the individual company might have used before.
Precisely. It aims for a more accurate economic reflection of the deal at that point in time. So what you see in those consolidated statements is based on fair value principles across the board for that transaction.
It's about reflecting the reality of the combination.
Exactly. Transparency, consistency in showing the value exchanged and acquired.
Right. Okay, so let's get into the weeds a bit. How a parent company might actually pay for a subsidiary. There are different ways, right? And fair value applies differently.
Absolutely. Let's start with the easiest one.
Cash.
Cash. If they pay in cash, it's straightforward. The amount paid is the amount recorded for that part of the consideration. Simple.
Okay, that makes sense. But what if the cash payment isn't immediate? Like they agree to pay $10 million, but maybe next year. No strings attached, just deferred.
Good question. That's deferred consideration. And here, the time value of money kicks in immediately.
Meaning $1 tomorrow isn't worth $1 today.
Exactly. That future payment of $10 million needs to be discounted back to what it's worth today at the acquisition date. We calculate its present value.
Using what, like an interest rate?
Using the company's cost of capital, essentially their discount rate. That present value is what goes into the goodwill calculation on day one, and it's recorded as a liability.
Okay, so the liability starts smaller than the final payment amount.
Correct. And then over the period until the payment is due, that liability increases. We call it unwinding the discount.
Unwinding.
Yeah, the difference, the increase each year, is treated as an interest expense. It hits the profit or loss statement.
So it affects profit later on.
Yes. But, and this is crucial, the original goodwill calculation, it's not touched by this unwinding. Goodwill is fixed based on the fair values at the acquisition date.
Okay, let's use an example. Say Pratco buys 80% of Swanco, January 1st, 20x1. They agree to pay $10 million cash, but not until January 1st, 20x2, a year later. And Pratt's cost of capital is 10%.
Perfect. So on acquisition day, Jan 1st, 20x1, that $10 million due in 1 year isn't worth $10 million yet. We discount it. $10 million divided by 1.10.
Which is about $9.091 million.
Spot on, $9.091 million. That amount is included in the consideration for calculating goodwill, and Pratt records a liability of $9.091 million.
Okay, then what happens at the end of the year, December 31st, 20x1?
Right, year end. The payment is now much closer. The liability needs to increase towards the full $10 million. So We calculate the interest for the year. $9.091 million times 10%.
That's $909,100.
Exactly. That $909,100 increases the liability on the balance sheet, and it's recorded as an interest expense in the profit or loss statement for 20X1. The liability is now closer to $10, ready for payment.
But Goodwill itself?
Unchanged. Still based on that initial $9.091 million present value.
Makes sense. It reflects the cost of delaying payment. Okay, now, related but different. Contingent consideration. This is also a future payment, but it's conditional.
Precisely. It depends on something happening in the future, like the subsidiary hitting specific profit targets, maybe.
Right. And normally, for uncertain future liabilities, the accounting is often just disclosure in the notes, maybe, if it's not probable.
Typically, yes, under standards like IAS 37.
Yeah.
But here's another big IFRS 3 override. For business combinations, if contingent consideration might be paid in cash, you must record a liability at its fair value on the acquisition date.
Even if payment isn't probable. Really?
Yes, even if it's not probable, IFRS 3 forces you to recognize the possibility right from the start. It's about reflecting all potential costs of the acquisition.
Wow. Okay. So how do you figure out that fair value if it's uncertain?
It's an estimate usually based on, well, a mix of factors. The probability of the event happening, how much would be paid, and again, the time value of money, discounting it back.
And what happens if that fair value estimate changes later on?
Good point. Any subsequent changes say it becomes more likely the target will be hit, so the fair value goes up. Those changes go straight to the profit or loss statement.
Not the Goodwill.
Nope, not Goodwill. Just like the unwinding discount, adjustments after acquisition day hit the P&L.
Let's do another Pratt Swan example. Pratt agrees to pay another $10 million 2 years after acquisition, but only if Swan's results grow by 5%. On day 1, Jan 1st, 20X1, they figure the fair value of this promise is, say, $4 million, because maybe growth looks unlikely then.
Okay, so even though it's uncertain, that $4 million fair value estimate is added to the consideration for Goodwill, and a provision, a liability for $4 million is recorded.
Then, a year later, Dex 31st, 20X1, things are looking up, Swan's doing well, the likelihood increases, and the fair value of that contingent payment is now estimated at $6 million.
Right, so the liability needs to increase from $4 million to $6 million. That $2 million increase
Does not go to Goodwill.
Correct. It goes to the consolidated statement of profit or loss, usually as an operating expense. It reflects the increased expectation of having to pay out.
Fascinating. It really forces companies to acknowledge these potential future costs up front. Okay, what about paying not with cash, but with shares? The parent company issues its own shares to the old owners.
Very common. And again, fair value is key. Even though no cash is moving, those shares have a value.
Their market value.
Exactly. The shares issued are valued at their market price on the acquisition date, and that total market value is added to the consideration used to calculate goodwill.
And how does the company record issuing those shares on its own books?
Good question. The accounting entry splits it. The nominal or par value of the shares issued increases the share capital account in equity.
The basic legal value.
Yes. And the amount above that nominal value, the difference between the market value and the nominal value, goes into another equity account, often called share premium or other components of equity.
Let's try the example. Pratt acquires that 80% of Swan's $5 million $1 shares. That's 4 million shares acquired.
Okay.
And the deal is, Pratt gives 2 of its own $1 shares for every 5 Swan shares it gets. And Pratt's shares are trading at $3.50 on acquisition day.
Right. So Pratt needs shares for the 4 million Swan shares it bought. The ratio is 2 for 5. So 4 million times 25, that's 1.6 million new Pratt shares being issued.
Okay, 1.6 million shares.
And each is worth $3.50. So 1.6 million times $3.50, that's $5.6 million.
$0.6 million, that's the fair value.
That's the fair value of the share consideration. So $5.6 million gets added to the goodwill calculation.
And on Pratt's equity side?
The shares have a $1 nominal value. So 1.6 million shares times $1 nominal value is $1.6 million. That goes to share capital.
And the rest? $5.6 million minus $1.6 million.
Oh, that's $4 million. That $4 million excess goes into the share premium account.
Got it. So the full market value drives goodwill, but the internal accounting splits it between capital and premium. Okay, so we've covered the payment side, cash, deferred, contingent, shares. But you said fair value applies to the other side too. What the parent company actually gets, the subsidiary's assets and liabilities.
Absolutely a critical point. It's not just about the price paid. You also have to figure out the fair value of what you bought. Think about buying, say, a used car. You agree on a price, but you also assess the car's actual condition and value, right?
Sure.
Same idea here, but for a whole company. All the identifiable assets, liabilities, and even some contingent liabilities of the acquired subsidiary must be adjusted to their fair value at the acquisition date.
Why? How does that affect goodwill?
Because goodwill is the price paid minus the fair value of the net assets acquired. So getting the fair value of those net assets right is essential for an accurate goodwill number. It ensures the consolidated balance sheet reflects the true economic substance.
Okay, so what kind of assets are we talking about? Stuff already on the subsidiary's books like property or inventory?
Yes, exactly. Take inventory. In its own books, the subsidiary might hold it at cost. But for the consolidation, IFRS 3 says it must be revalued to fair value, likely its selling price less costs to sell.
And property.
Same idea. If the subsidiary held property under the cost model, maybe its value has gone way up. For consolidation, it might need to be adjusted to its current fair market value.
So if these fair values are higher than the old book values,
then the subsidiary's net assets are worth more. And if the net assets are worth more, the difference between the purchase price and those net assets, which is goodwill, actually goes down.
Okay. So higher fair value for assets means lower goodwill. That makes sense.
Yes, it leads to a potentially smaller, more accurate goodwill figure, but there's a knock-on effect.
Oh.
If you've increased the value of an asset that gets depreciated, like a building or machine.
You have to depreciate the higher value now.
Exactly. An additional depreciation charge needs to be calculated in the consolidated accounts based on that fair value uplift.
And that reduces profit.
It does. It reduces the subsidiary's post-acquisition profits reported in the consolidation. And that reduction affects both the parent company's share of the profit and any non-controlling interests share too.
Wow. Okay. So fair value adjustments echo through future profits via depreciation. Now, you mentioned identifiable assets. What about things a subsidiary might have developed itself, like a brand name or some research that aren't even on its own balance sheet because accounting rules often forbid that?
Fantastic question. This is another really interesting aspect of IFRS 3. You're right. Under standards like IAS 38, companies usually can't capitalize their own internally generated brands, customer lists, or similar intangibles.
Right.
But in a business combination, if these internally generated intangible assets are identifiable, meaning they could be sold separately or arise from contracts or legal rights, they must be recognized at their fair value in the consolidated financial statements.
Even if the subsidiary never had them on its books.
Even then, it's another case of IFRS 3 prioritizing the fair value of everything acquired in the deal. If the parent effectively paid for that brand, it should be recognized.
So that increases these subsidiaries' assets in the consolidation.
Yes, it increases non-current assets. And just like fair value uplifts on tangible assets, recognizing these intangibles
Reduces goodwill?
Exactly. It reduces goodwill. Then, depending on the asset, if it has a finite life, it gets amortized over that life, reducing future profits. If it has an indefinite life, like some brands might, it doesn't get amortized, but must be tested for impairment every year.
Okay, that's a big one. Recognizing assets that weren't there before. Now let's tackle what you hinted might be the trickiest bit. Contingent liabilities. We talked about contingent consideration payments the parent might make. What about potential obligations within the subsidiary itself? Like an ongoing lawsuit, maybe?
Right. This is often seen as counterintuitive. Normally, under IAS 37 again, if a company has a potential obligation, like from a lawsuit, where the outflow of cash is improbable, they would just disclose it in the notes. They wouldn't record a liability on the balance sheet.
Makes sense. It's uncertain.
But IFRS 3 strikes again. In a business combination, a contingent liability of the acquired company, if it's a present obligation arising from past events, even if payment isn't probable, must be recognized at its fair value in the consolidated statement of financial position.
You have got to be kidding me. Even if it's not probable, they'll have to pay out.
Yes. The logic is that the acquiring company would have considered this potential risk when setting the purchase price. They likely would have offered less because of this potential future cost.
So the accounts have to reflect that risk they took on.
Exactly. Recognizing this potential outflow increases the liabilities assumed in the deal. And if liabilities go up,
Goodwill goes up.
correct. Recognizing contingent liabilities at fair value actually increases the initial goodwill calculation.
Wow. Okay. And what about changes later, if the lawsuit looks more likely to be lost?
Subsequent changes in the fair value estimate of that contingent liability are recognized in the consolidated profit or loss. Again, they don't adjust the original goodwill figure.
Right. Goodwill stays locked from day one, based on those initial fair values. This whole deep dive really highlights just how central fair value is, doesn't it? It's not just one number. It shapes the consideration paid, the assets acquired, the liabilities assumed, everything feeding into Goodwill.
It really does. And it underlines that core theme. IFRS 3, the business combination standard, often sets its own path, prioritizing fair value to give a true economic picture, sometimes overriding other standards.
These aren't just like accounting quirks then.
Not at all. These fair value adjustments are absolutely vital if you want to genuinely understand a company's financial health and position right after it's made a significant acquisition. It's about seeing the real value exchanged.
Okay, so thinking about all the specific rules for deferred and contingent payments, how assets get revalued, how even unrecorded brands or uncertain liabilities have to be brought onto the books at fair value, how this all impacts goodwill and future earnings. What really stands out to you listening to this? How might knowing this change how you look at a company's financial statements next time you see news about a big merger or acquisition? What might be hiding or perhaps revealed just beneath the surface of those numbers? Something to think about.